This week on WealthTrack, five-star Yacktman Fund Manager Don Yacktman mines for bargains in the stock market. How is this great investor using tried and true methods to strike investment gold? Where he is digging is next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. We are taping this week's program at the Museum of American Finance, a must-visit destination in the heart of Wall Street. Well, some things never change. Recent WealthTrack guest, Gluskin Sheff's influential economist and strategist David Rosenberg has been getting flack for moving to a more bullish stance after years of warning about economic and market risks. He explained his shift in outlook to us, and the Wall Street Journal recently covered the backlash from some of his followers in its article titled "Top Bears Bullish Tilt Has Followers Growling." Rosenberg is not alone in seeing strength where there was once weakness. Another highly respected economist and strategist, Ed Yardeni, recently wrote about a possible market melt-up. Yardeni pointed out that in recent weeks, the stock market continues to make new record highs, led by stocks with above-average PEs. If you look at market performance year to date, the difference among small, mid-sized, and large company stocks in particular is marked. Small cap stocks, as measured by the S&P 600 index, have outdistanced the mid-cap S&P 400, and both have raced ahead of the large cap S&P 500. Yardeni also notes that the pattern of outperformance among smaller company stocks is fairly uniform across different sectors and industries, whether it's energy, healthcare, or consumer staple stocks. This divergence in performance is exactly what this week's great investor guest looks for. He is value investor Donald Yacktman, president and founder of Yacktman Asset Management, and co-portfolio manager of the 20-plus-year-old Yacktman Fund and the younger Yacktman Focused Fund. Both are rated 5-star by Morningstar and have beaten the markets and their peers by wide margins over the years. Yacktman is also a past Morningstar Stock Fund Manager of the Year award winner. The last time I interviewed him, in January of 2012, he described the values in the market as amazing. I asked him how he feels now.
We tend to be very bottom up.
Yes, you do.
And the best indicator probably is our cash position, which is, again, from bottom up, and it's about a 20% level. So it's varied between 0 and 30.
So you're in the high end of your
higher than normal, yeah. And
so what does that tell me about how you feel about the market then?
Well, the dilemma is this. We'll always feel comfortable on a relative basis.
And explain to our viewers what that means.
Well, because we have, of our process, we have two goals. One is to protect our clients' money, and that is from bad decision making and also from inflation. And the other one is to grow our clients' money by making equity double-digit type returns and beat the S&P from one market peak to the next market peak. And what we use is risk-adjusted compounded forward rates of return. So like a CFO and a management team having projects out there, if they can find enough above their cost of capital, they should do it. So within the parameters of our prospectus, we will fill it up as much as we can. But what happens is we'll either hit certain lids, and we're in an environment now where it doesn't pay to downgrade, and the spreads between high quality and lower quality equities has narrowed pretty dramatically, and so we're in very high quality securities.
So when you say the spreads between high quality companies and low quality companies have narrowed dramatically, you're talking about the returns?
Yeah, the forward rates of return, yeah. As we perceive them,
right,
We think that you're just as well off in most cases to own things like our top holdings, which are Procter & Gamble, Pepsi,
Right.
Coke, Fox.
News Corp, right, exactly, yeah. So have there been times when you've actually, with the Yacktman Fund, because I'm looking, I mean, a 7% annual turnover, which is very unusual. Have there been times when you've actually kind of gone down the quality scale and actually bought low quality companies just to participate in a market?
Yeah, typically when you have very disruptive periods, you will find that the tail of the bell curve gets elongated and there'll be more opportunities. But opportunities usually come from declines, not from rises in the market. As the market's rising, it's just like the compounded rates of return get lower, not higher.
So when were you in a disruptive period that you actually went and again, I'm thinking of your turnover rate, which is so low. So have there been actual times when you've like had a much higher turnover and when you see opportunities?
Yes, in 08 and 09,
right.
Our turnover rate was probably about 70%.
7-0.
7-0.
From 7% now.
Right, because what happened is you got in this disruptive period, we used up all our cash, and then we were starting to use up securities that had lower rates of return to take on something that may have double. For instance, selling Procter & Gamble to buy News Corp and Viacom would be an example of that. Whereas Procter had held up very well, the other two had been cleaned out.
With the thought of preserving capital being one of your major goals and then having these double-digit forward rates of return you're talking about, and you're talking about actual forward rates of return in the stock performance, right? That's what you're talking about. So looking at your top holdings, I mean, Procter & Gamble is still there, one of your largest holdings, and News Corp, which you've held for a while as well. Where does the conviction come where you decide to stay with the Procter & Gamble and not do some more trading at this point?
Well, what you'll see is some trading on the edges, and then because we've had so much positive cash flow, some of those turnover numbers are really a little deceptively low, because if you don't buy, when you get new money, if you don't buy exactly in line with what you have, it's turnover, but it doesn't show up in the turnover numbers.
I see.
So like Coca-Cola, for instance, if you go through the last, say, 10 years, or 15 years ago, Coke hit its all-time high at 44.5. We thought it was overpriced at that price. But like 5 years later, we started nibbling and it was roughly half of that kind of price. And by 07, it was our largest holding and we had over 10% in it. But then as it ran up, we basically reduced its holding size. It dramatically went lower because the compounded rate of return was going lower. Whereas in the last quarter, we added back some Coke because the price had come in and so the forward rate of return had gone up.
So do you have a maximum, percentage that you'll have of a stock in a portfolio? I mean, for instance, right now, News Corp is 9% of your portfolio. Is there, kind of no matter what happens, you're going to say we're not going to go beyond 10%, or we're not?
Yeah, I would say we don't go above 10 very often.
Right.
But it's actually the Fox part of News Corp. The other one is which is the old News Corp, which is the newspaper business. It's a small part. The big driver in Fox is really Fox Cable News.
Right. And so you still have conviction in the Fox part of News Corp, in other words.
More so.
So what is it about that business that you're still saying to your shareholders in the Yacktman Fund, look, we still want to keep it at 10%?
Well, it's not probably as big as it was at one time, but remember this company, because they've really found a niche in the news business that wasn't being covered basically. And it's bigger than MSNBC and CNN combined.
And that's in this country alone, which is a major media market, right?
And then from that, they're kind of doing add-on stuff like Fox Business News, Fox Sports, and so they're spreading out into those areas. And in addition to that, they have moved from more of an ad-driven business to a fee-driven business as they've made this move, which is more of a solid evergreen type income stream.
So that's kind of the future that you see as well. If you're looking at a media company, I mean, you own Viacom, as you said, at 1.2, so you probably are you know the business. That's kind of that's a direction that you like to see a media company taking?
Well, we like this business model very well. And,
yeah.
But if you look at like the media companies where they've become a smaller percentage of our portfolio because they've done so well, Viacom, Comcast, as well as obviously Fox and Liberty Media. Whereas now some of these big companies like Coke and Procter and Pepsi have underperformed the S&P over the last couple of years, so that on a relative basis, they just look better to us going forward.
Right. So, I mean, aside from the relative basis issues, I mean, I'm looking at with the names that you just mentioned, Pepsi and Coke and Procter and Gamble. So those are big global companies. I mean, what else do they, what do they bring to the table when you look at a P&G, which a lot of people look at Procter and Gamble and they just yawn.
Rightfully.
Yep. I mean, sometimes boring can be profitable, I guess. But what is it about Procter and Gamble at this moment in time that really does it for you?
Well, again, as my associate Jason says, it's almost always about the price. So,
yeah.
That'll be the driver on all these things, will be the prices. Think of them as being like AAA bonds, and that they're adequately priced as a AAA bond with everything else out there. But if you look at the business model of Procter & Gamble, I mean, you're talking about businesses that in general are number one or maybe number two in all their product categories. They have enormous product categories. They're like a printing press printing money, and it's more a function of price. But you're right, I mean, it is, to most people, it's kind of a yawn.
Yeah, so it's so interesting how the market looks at a Procter & Gamble, for instance, and that these things go in and out of favor. Is this kind of a contrarian as well, move on your part when you're going to take a big position in a Procter & Gamble or a Pepsi?
Yeah, usually you'll find us buying when things are not real rosy as far as the market's feelings on the company. We'll be buying into dips usually.
So there were some other, I know you own two big tech companies. I mean, among your top 5 holdings are Microsoft and Cisco. So Microsoft, Steve Ballmer, just retired. So what's your take on Microsoft?
Well, we're hopeful that the board of directors will select somebody who's good in capital allocation and an improvement from what we've seen over the last few years.
So you don't think that Steve Ballmer as the CEO was good at allocating, where their investing and acquisitions should be, or what it should be investing in the businesses?
Yeah, we think there could be improvement.
Okay.
But we have actually 3 of the top 11 holdings. You mentioned Microsoft, Cisco, Oracle we bought for the first time in the second quarter of this year. We sold Pfizer and actually got a higher price than we bought Oracle at, but it wasn't that we traded one for the other, it just happened to work out because we do them all one at a time. So
what's the attraction of Oracle? What is it about that business model? And
yeah, it's again a combination of looking at a profitable business at a low price.
Yeah. So looking at your portfolio mix here, so you've got some really big consumer brands, global consumer brands, and then you've got what are considered now to be kind of the old-fashioned tech companies.
Mm-hmm. Yeah,
and,
old tech.
Yeah, just old tech. Look at what Facebook's done, and Google, and have you ever considered playing in the more the new tech, social media type of area? Is that been
ever's a long time,
Consuelo.
Yeah. I think you'd find it rare for us to be buying something that's selling at 100 times earnings or something like that. That just mathematically, I think those are difficult to swallow.
Yeah. So it's not you're making again. You keep coming back to price, and when I'm looking at you've got 20 plus years of investing with the Yacktman fund, and you've been through a lot of market variations, a lot of booms and busts and crises and everything else. Has your approach changed at all over the last 20 years?
Not really.
No.
One of my, we have 7 children, and one of them after dinner said to me once, we were talking about investing, he said, "Let me see if I get it, Dad." He said, basically, what you're saying is if you buy above average businesses at below average prices, that on average it's going to work. And I said, yeah, that may be an over-exaggeration, but yes, that's the basics.
Is that the son, Stephen, who
Actually,
is
this is
in
a
business
different
with you?
Stephen's been with me, but this is another son, Brian, who actually is in our business as well, but
Right.
a different company. But.
Yeah. So Stephen Yacktman, I mean, you recently basically retired as the chief investment officer of the Yacktman funds, and Stephen has succeeded you. So how did that come about?
Well, I think it's a recognition of his efforts. I mean, Steve is a marvelous businessman and really understands investing and understands business, which is the critical variable, price and business models. And this is really something that should be done because of his efforts in the company and the contribution he's made. My role really hasn't changed, but I think he should be elevated and recognized for all that he's done and contributed. By
most standards, you run a pretty tightly focused portfolio as well in the Yacktman fund and the focused fund, which is named the focused fund for a reason. But what, a third is in the top 5 holdings, over 50% in the top 10. So what's the again, preservation of capital? What's the thought there? Why is that part of your philosophy?
Well, again, if you think in terms of bell curves, what we're trying to do is get the ones that are in the tail of the bell curve. And the more money you can put in those positions, the better off you are. You actually, in our opinion, you reduce risk, which is loss of capital, by doing that, not increase your risk. But I think there's no substitute for knowledge and assessing risk correctly. We're not perfect. Nobody can predict the future with absolute certainty. But we are very adamant about controlling risk and for our clients to the best of our abilities.
And so the way you're controlling risk is, again, paying a cheap price. I mean, this is the value investors' kind of creed. I mean, one of the things during the financial crisis that a number of value investors blew up. You did not blow up, but because they were focusing on like forward earnings, for instance, and they weren't focusing on what was going on with the balance sheet. They weren't looking at the creditworthiness of the company. They weren't looking at its need to access the capital markets, that they had sufficient cash on hand to continue to do their business, even if they couldn't basically borrow. So how did that figure in, and has that changed your thinking about how you look at companies at all?
Not really. I think the business model, understanding the business and what makes it tick is part of this process, because it all boils down to what you buy and what you pay for it. That's really the basic criteria of investing. And so, we'll adapt though. I think that one of the things that we did very well is adapt to the environment. But again, if the focus point is continually on the best forward risk-adjusted rates of return, then you'll always be doing the best possible job you can within the limits of anything that the process is correct, but anybody who's using the process, it's sort of the old garbage in, garbage out. In other words, it's the process is great, but the input data, the assessment of business and price is the critical part of the process.
Have you adapted your, that assessment at all? Are there more inputs now after the financial crisis than you had before, or is there a greater emphasis? You really haven't had to change.
No. I think in life there are certain things that one can control and there are things you can't control. So we focus on what you can control. In other words, we're going to set the sails, but regardless of what the wind is doing.
When do you decide basically to sell a stock? I mean, when you're looking at a Procter & Gamble, for instance, or again, any of the, or Pepsi, or so at what point do you decide to sell?
Well, normally it's a gradual process. In the case of like Pfizer, it kind of had a run, and it reached a point where we felt comfortable letting the whole thing go. But usually it's normally a slow, gradual process out, because the rates of return are going down as the stock price goes up, and vice versa.
So looking at the forward rates of return, so which companies do you think have the highest forward rates of return in your portfolio right now?
Well, the easiest way to tell is just by looking at the ones we have the biggest positions in, because logically, if you follow the process we're doing, you're going to put the most money in the one that has the best risk-adjusted forward return. So the one that's moved up the ladder the most in the last, say, 3 months would be Coca-Cola. I'm talking about everything prior to the end of September 30th. When, but you can see that it's moved up the ladder because it's come down.
Right.
And I recognize that Coke hasn't shot the lights out in the short term. We're long-term investors. It's a marathon, not a sprint. And we just have a much longer horizon time than I think the average investor.
So why would you own Coke and Pepsi? Are they sufficiently different that, I mean, it's okay to have the two major, soda companies and consumer snack food companies or whatever? That's...
I would say two things. One is they are very different. Pepsi, the biggest component of Pepsi really is Frito-Lay. They could change the name to Frito-Lay.
Right.
Whereas Coke is like 80% foreign in mainly a carbonated beverage business. But both of them are spectacular business models, so why not own both? I mean, if you can get them at the right price.
But you said earlier that Pfizer, for instance, that you sold Pfizer when the price went up, because sometimes you can have a situation where a company has grown tremendously in your portfolio because it's just that it's appreciated a lot. So it's kind of, so what's the difference?
Maybe I can use an analogy to describe this, and that is, think of what we're doing as buying beach balls that are being pushed underwater and the water level is rising. The faster the water level rises, the more you're willing to hang in there, and particularly if the beach ball stays down. So what I'm saying is that Pfizer starts to look a little bit more like a moving sidewalk than it does an escalator when you look at the forward product categories and what's rolling off of patents as well as what's coming down the pike. It's a lot different company than it was 20 years ago, and we also owned a big chunk of it. We sold it out in the in the late 90s when we thought it was way overpriced.
So of course everyone, including myself, is focusing on your top 5 positions or your top 10 positions, but there are lesser positions as well. So are those more are those you're going to wait and see what happens, or in the lower half of your portfolio, what's going on?
Yeah, I think there's a combination of 2 or 3 reasons that could put them in there. One is as you look in the future, and I said nobody can predict risk, you're looking at an array of outcomes. So the wider the array of outcomes are, the more risk is in there, whether it's financial or operating leverage that causes it, like say Hewlett-Packard or Avon or something like that. And so what we'll do then is think of it conceptually again as though you're drilling wildcat oil wells. You want to spread your risk.
Right.
You want to reduce the amount of money you have in each one, but know as a package that you can feel comfortable. And you know that some of them may not work out particularly well because of this wide range of outcomes. But it's risk control again. So that could be one of the reasons we have a smaller holding. And some of them have worked out well and some of them haven't worked out so well. And then the other side could be a great business, but it's smaller in size, and so there's a limit as to how much we can own of it. And so we'll have to have a smaller position of our portfolio given the size of the portfolio today.
So the next time I have you on, Don, I will ask you about the latter, the lower half of your portfolio. So one investment for a long-term diversified portfolio, what would you have each of us own in a long-term portfolio? In
today's market, I think where Coca-Cola is, if somebody wants to buy something and just put it in the drawer, they can feel pretty comfortable with something like that.
Okay, if only we could still get certificates. We could put it in the drawer, in our portfolio drawer at any rate, I know. Yeah. Don Yacktman of the Yacktman Funds, thank you so much for joining us on WealthTrack.
Thank you for having me.
Incidentally, it's getting harder and harder to find companies that issue paper stock certificates. The death knell for that now extremely rare practice was sounded just recently when Walt Disney stopped printing its stock certificates. They have been collector's items for years because of their high-quality artwork with a portrait of Walt Disney surrounded by some of his most beloved characters. They were also a great teaching tool for youngsters. So this week's action point is, if you want to see some historic stock and bond certificates, come visit the Museum of American Finance at 48 Wall Street the next time you are in New York City. It has a wonderful collection of historic documents, including bonds signed by none other than George Washington and other founding fathers. Its interactive exhibits take you through the exciting and tumultuous financial history of this country, the booms, busts, and innovations that have made the U.S. the economic and financial powerhouse that it is. A visit will make you a much more knowledgeable investor, and knowledge is power. Well, next week we will discuss why promoting women, water conservation, and communities can make a difference in your portfolio with socially responsible investing leader Barbara Krumsick, the CEO of Calvert Investments. In the meantime, please visit our website, WealthTrack.com, to see this week's interview and our extra feature with great investor Don Yacktman. We also look forward to connecting with you on Facebook and Twitter. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter.